In the 1980s, the Turtles famously used the Donchian Channels to make millions in the stock market. 4 decades later, do the Donchian Channels still give you an edge? To find out, let's program a simple Donchian Breakout strategy and do a long-term backtest on the pound yen. Donchian channels are formed by plotting the highest high and the lowest low over the look-back period. A middle line, which is the average of the upper and lower lines, is sometimes plotted to indicate the average price. There is only one input parameter, the look-back period. A short look-back in the 20 to 40 bar range will be good for mean reversion or short-term trend followers. Longer periods like 60 to 100 will be better for capturing the longer-term trends. The Turtles actually traded 2 versions of the Donchian Breakout strategy, one with a 20 bar look-back and one with a 55 bar look-back. There are 3 common ways to use the Donchian channels. First, you can use the width of the channel to gauge market volatility. Notice how the channels rapidly expand when a non-farm payrolls is released. If you want to avoid noisy markets, you can set a maximum allowable channel width. Next, you can use the middle line as a trend filter. For example, you can choose to only take long trades when the price is above the middle line. Lastly, and most importantly, the penetration of the channel boundaries indicates strong momentum and a possible breaking of support or resistance. This is how we are going to use the Donchian channels to ride the long-term market trends. Let's talk about entry conditions. Here's an example of a long entry. I will go long when the close is above the 80-period Donchian high. That is quite a loose condition, so I will add 3 entry filters. For the time filter, I will only trade during the London session. For the trend filter, I want the 80-period EMA to be rising for at least 10 consecutive bars. Like swimming with the tide, trading in the direction of the long-term trend will improve win rate. Lastly, I want to make sure there's an increase in short-term volatility as measured by the 5-period average true range exceeding the 80-period average true range. This volatility filter helps avoid many false breakouts, which sometimes occur during the quiet Asian hours. For exits, a simple Friday exit and a 100 pip stop loss and trailing stop will be sufficient. AlgoWizard does not have the Donchian Channels indicator, but you can use the highest function, which returns the highest price over a given look-back period. For the 10 bar rising EMA condition, we can conveniently use the is rising condition, where we only need to select the number of consecutive bars required. And for the volatility filter, I will add a multiple to the 80-period ATR. This lets me control the strictness of the filter depending on whatever trading frequency and win rate I am targeting. The exits are in place, and now let's run our 11-year backtest. The equity curve looks good to me. We don't have any steep drawdowns, which gives us a decent return over drawdown ratio. Out of the 11 years in the backtest, 8 were profitable. Like most trend following strategies, we have a relatively low win rate, but with the 1.7 payout ratio, we still get an overall expectancy of about 11 pips per trade. So to answer our original question, yes, the Donchian channel still works despite its simplicity. A portfolio of logical and simple strategies, combined with realistic expectations, is enough to make you consistently profitable. For more backtested strategies, be sure to like, comment, and subscribe. Keep your trading simple, and I'll see you at the next video.